Good evening, Lankesh. Let's wait for around 5 more minutes. All right, guys, let's start. So, today I'm planning to revise two chapters, that is capital allowances and inheritance tax. After that, we'll move on to two questions from the from two past papers. So that would be the plan for the day. So first of all, can you guys recall what is meant by a capital allowance and why did we require the capital allowance? Why this whole capital allowance story came into the picture? Can someone recall about that? Uh, Great, super. So, so capital allowances came into the picture as an alternative for the depreciation. So we did not allow accounting depreciation to be deducted for the tax purpose. But why didn't we allow it? Any particular reason? Why didn't we allow the depreciation? It's non-cash, right? So I would say Lankesh's answer is partially correct. So guys, it's not purely because of its non-cash. Great. The main reason why we did not allow the accounting depreciation was it was a accounting estimate, which was very, very subjective. For an example, what is depreciation? We simply try to split the cost of a asset throughout the estimated useful lifetime. Then what is this estimated useful lifetime? Do we have a clear cut method? Okay, this is how we are going to estimate it. We don't have any such specific guideline. And the useful lifetime for the same asset might be different from individual to individual assessment. So it was a subjective. That is why we had to come up with a different mechanism to overcome this subjectivity. So that alternative mechanism was known as capital allowances. Then types of capital allowances. So what were the main types of capital allowances we had? As I always say, this is a revision. So let's try to be interactive because by now you should have studied all these stuff. It's just a revised stuff that we are trying to do now. What would be the main types of capital allowances we had? Okay, good. We had annual investment allowance, AIA. Right, great. So we had FIA, AIA, and WDA. So basically, annual investment allowance, first year allowance, and written down allowance. These were the main stuff. Right. So what were the basic stuff about AIA? Great. We have 1 million limit. Good. What else? Awesome. So we are applying AIA on plant and machinery, and we do have a 1 million limit for a period of 12 months. So if our actual period is less than or more than 12 months, we need to time apportion this 1 million. So if our counting period is 9 months, we have to divide this 1 million by 12 and multiply by 9. If our counting period is 18 months, we need to divide this 1 million by 12 and multiply by 18. So likewise, this 1 million is an annual limit. So depending on the length of the counting period, we will have to time apportion that. This is again a crucial thing, guys, because based on my experience, what I have noted is most of the times students miss to pick this one because they are not going to say it's a short accounting period or a long accounting period. They will say starting date and the end date. So from that, you have to analyze whether it's a short period or a long period. Accordingly, you will have to adjust AIA. So be mindful about the time period or the length of the accounting period, especially when it comes to capital allowances. Then, this is applicable for both main pool and special rate pool assets, not just the main pool. And when we are claiming annual investment allowance, when we are claiming AIA, against which pool should we claim first? AIA or, special rate pool or the main pool? Which pool should we first claim capital allowance AIA? Okay, I got one answer as special rate pool, two answers as main pool. All right. Guys, again, basics. First, we have to claim against a special rate pool. Why? Think logically. If I first claim against the main pool, the remainder in my special rate pool, I can get WDA only at 6%. But if I claim annual investment allowance against my special rate pool first, the remainder in my main pool, I can claim WDA at 18%. So as a taxpayer, I would definitely be happy to claim the maximum amount that I can claim. Therefore, I would prefer to go against a special rate pool first. Exactly. Are we clear? Why are we setting off against a special rate pool first? Are we good? Okay. And we do not grant AIA for cars and buildings. So both these assets we do not grant AIA. And AIA is not given in the last accounting period as well. When you decided to cease your trading, when you decide to close down your business, then AIA is out of the equation for you. Coming back to WDA, this is something similar to your accounting depreciation. So a fixed percentage will be granted. Yes, at the time of seizing, nothing is allowed. For main pool, the WDA is 18%. For the special rate pool, WDA is at 6%. Then first year allowance is only applicable for new zero CO2 emission cars. If it is a second-handed car, even though it's a zero CO2 emission, we do not grant FIA. FIA will be given only for new zero CO2 emission cars. So are we good about the basics around these capital allowances and how does it work? Are we okay? Great. Then what are the pools we have? So we have three main pools. Main pool, or we call it as general pool, special rate pool, and the small pool. So what comes under the main pool? What are the things that we capture under the main pool? Okay, I had a question. During the cessation period, if there is a zero CO2 emission car, what will happen to that? Okay, it's a good question. Uh, If it is a zero CO2 emission car, take it to the main pool since we are not giving the FYA in the last year. Are we okay, Lankesh? Right. So, okay, what is included under the main pool? I got one answer as plant and machinery. What does plant and machinery include? Okay, air conditioning, computer software, good. Equipment, okay, good. Moving partition, okay. Guys, what are the main stuff? What are the big stuff? Machines, plants, cars and lorries, computers, software, any alteration done to a building in order to install a machine. All these comes under the main pool. Are we good? We are clear? Great. And second-handed zero CO2 emission cars also we take to the main pool. Low emission cars. So what is the CO2 emission to measure whether it's a high emission car or a low emission car? What's the CO2 emission level that we measure whether it's a high emission or low emission? Great. It's 50 grams per kilometer. If the CO2 emission is less than or equal to 50 grams per kilometer, we say it's a low emission car. If the CO2 emission is more than 50 grams per kilometer, then we say it's a high emission car. Good. So special rate pool, we are taking long life assets, integral features of buildings and structures, thermal insulations and building, and high emission cars. Right. So what includes these long life assets? What are the criteria to measure whether it's a long life asset or not? 25 years. Okay, I got one answer as 25 years. Okay, or 50 years. Okay. The others? Okay, asset value is above 100,000. Good. The time period, is it 25, 50 or something else? Okay, right. So it's 25 years and 100,000. Both criteria needs to be met. Good. So what do we mean by this small pool? What comes under the small pool? Can anyone recall what do we take under the small pool? Right. Below 1,001. Okay, good. Apart from these main categories, we had something called short life pool as well. What was that? Apart from these, we had something called short life pool as well. What was that? Great. That was assets that we have purchased with the intention of selling within 8 years, disposing within 8 years. Those assets we kept separately. Why? Because we expected those assets to be sold or disposed in the near future within the next 8 years. We kept them separately. And we granted the capital allowances also accordingly. Why? What's the benefit of keeping it in a separate line or a separate column? Why do we bother to do that? Any reason? Why are we bothering about keeping these assets separately? What is the benefit for the taxpayer? No, WDA policies are same. There is no change in the WDA policies. Any reason, any advantage for the taxpayer by keeping these assets, which he is planning to dispose within 8 years in a separate line? What's the advantage for the taxpayer? Okay. Usually, when you dispose an asset, what do you do? For tax purpose, I'm asking, not the accounting perspective. From tax perspective, when you dispose a depreciating asset, an asset for which you have granted capital allowances, when you are disposing such an asset, what would you do? Guys, I'm raising basic questions. Come on. When you dispose an asset, what would you do for the tax purpose? How are we going to calculate the gain? I'm asking a common asset granted with capital allowances. Okay, let's say you have a machine which you have categorized in the main pool, and now you are going to sell it. So when you sell it, what will you do for tax purpose? That is the question. Is the question clear? Right. So what would you do then? No, I'm asking from the capital allowances perspective. Forget about the CGT for a moment. Yes, please go ahead, Elankesh. The others also, please share your thoughts. Come on, guys. Right. So I'm again repeating the question. The question is, there is a machine which is classified under the main pool. Now you are disposing that. From capital allowances perspective, what will you do for it now? Or what should you do for it now? Elankesh, Ijaz, Hamna, Ahid, what are your thoughts? How are we going to calculate the balancing charge or the allowance? Remember, it's in the pool. It's in the main pool. Simply, guys, we cannot calculate the balancing allowance or the balancing charge. Why? Because it's in the pool. We do not know exactly how much capital allowances we have granted for the asset. So we are not in a position to calculate the balancing allowance or the balancing charge. So what would you do? Elankesh's previous answer is correct. We take the original cost, compare that with the sales proceeds that you received. Out of those two, lower one we deduct from the pool. Still the same thing, Lankesh. Like I said we had this discussion earlier also when we were doing the capital allowances chapter. I recall. So doesn't matter how many assets are there in your pool, you cannot deviate from the process. So unless you have kept that asset in a separate line, for an example, private use or short life assets. In that case, yes, you can calculate the balancing allowance and balancing charge. But if the asset is in a pool, even though it's only one asset, the same adjustment we have to do. Sales proceeds, compare against the initial cost, lower, deduct from the pool. Are we good, guys? Elankesh, are we good? Great. Ijaz, how about you? Right. The benefit of classifying in the short life asset pool would be when you dispose the asset, you exactly know how much was the cost and how much was the capital allowances granted. So you can actually calculate the balancing allowance or the balancing charge because you kept that asset separately. So you know the exact amount of capital allowances that you have granted for the asset. So based on that, you can calculate the balancing allowance or the balancing charge and take that your tax adjusted trading profit. But this is beneficial only if you are sure that the sales proceeds or the disposal proceeds from this asset would definitely be lower than the initial cost. In that kind of a situation, it is advisable to go ahead with a short life asset. Are we good? Is that clear? Elankesh, Ahid, are we okay? Great. So with that, the revision of the capital allowances, I'm going to conclude. Any questions about capital allowances? Anything that you guys are not clear or you would like to get clarified about the capital allowances? Elankesh, anything from your end? Ijaz, how about you? Ahid, Rashid? Right. Yes, I agree. Usually doubts come when you start doing questions. But guys, now it's already what do you call mid May. So how many more weeks you have for the exam? How many more weeks do you have for the exam? Yes. I would say less than 3 weeks even. Last week or last few days, you won't be 100% focused, right? Because last few days we can cut it out. You would be pressurized in the last few weeks, nervous. And some people might have other exams to attempt as well. So it would not be only one paper for some. So if you take out the last few days, we are talking about less than 3 weeks. So it's now or never. You guys have to start studying. So based on the answers that I'm getting from few of y'all, I can see that you guys cannot recall some of the basic stuff, which is bit of a alarming, guys. So take couple of days and make sure you go through all the theories and you're comfortable with the stuff. After that, it's all about practicing questions. How much you can practice, that's better. So start revising yourself. That's the objective of this whole program as well. And start practicing questions. Are we good? Great. Okay, then let's move on to a quick recap on inheritance tax as well. It's not a threatening area, I would say. Inheritance is not that bad. The problem with inheritance would be, okay, what's happening here? Give me 1 second, guys. Something happened with the PowerPoint. Okay, I have opened the PDF, sorry. But don't worry, guys, about the nil rate ban that much because in the recent past, they haven't tested this whole nil rate band accumulation part that much. Because in inheritance, it's a very, very tiny area. We have a lot of other areas, complicated and interesting areas to check. Right. So coming back, what are the important concepts about the inheritance tax? I would say interesting suits because I will do one exam question after we do this revision part today about this inheritance full story. That was a nice exam question, which was honestly interesting. I felt it was a very nice question, which test around the conceptual knowledge about the students on inheritance and to a certain amount on capital gains tax as well. So it was a very, very smooth and nice question. So we look into that question after this recapping part because your questions on inheritance in exam is not going to be boring. It's going to be very interesting, but you should be able to think around. This is the most interesting, I mean, this is the area where you can get most interesting questions because this one they can tie up with any other chapter. Easily they can tie up this with CGT. Easily they can tie up this with individual income tax. Easily they can tie up this with national insurance contribution. So this area they can easily tie up with any other except for corporation tax and VAT, any other area they can easily tie up with this inheritance tax topic. Yes, good questions are there in the study of on this inheritance. Plus, like I said, there's a very, very interesting exam question as well around CGT and inheritance, a combination of these two. So, like I said, this is an area which we can easily combine with most of the other taxes. There's a part in corporation tax about enhanced capital allowances. Yes. Enhanced capital allowances is there in corporation tax. In our next revision class, we will revise about the corporation tax and all. When we are doing that, I will include this, what do you call it? Enhanced capital allowances part as well. Yes, it is testable and it has been tested in certain exam questions. We are good? Right. So coming back to the important concepts in inheritance tax. So these are the main three important what do you call concepts? Transfer of value, chargeable property, and chargeable person. What do you mean by transfer of value? Yeah, no worries, Ijaz. Go ahead. Guys, what is meant by transfer of value? Uh, Giving the asset to someone. Okay, all right. Telankesh, Ahid, how about you guys? Difference between the value of the gift before and after for a trust or family. Okay, all right. Ahid, what is your view? Sorry, I didn't follow you, Ahid. What do you mean by just or PET or CLP? Okay, all right. Okay, right. Again, guys, these are basics. Transfer of value means a transaction which creates a reduction in the portfolio of assets, the estate, the donors or the transferor's estate, uh, when if because of a transaction, if the transferor's estate comes down, reduces, that is known as a transfer of value. So yes, the formula is value of transfer before the gift, sorry, value of estate before the transfer and value of estate after the transfer. The difference between that would be the value of transfer. But the answer to the question I raised is, I didn't ask for the formula. I asked the meaning. What is meant by transfer of value? Transfer of value means what you called a transaction which causes a reduction in the estate of the donor. Are we clear? So guys, always answer to the requirement. Don't just remember the formulas and try to stick to the formulas. Always answer to the requirement. So if the requirement or the question was the one that I asked, if you give the formula, you might not get the marks. It depends. There were instances like there were some questions where they directly asked what is tax evasion, what is tax avoidance, and yeah, there are some occasions like that where they have directly asked some theoretical areas as well for around 2 marks. This is around section C. In section C, sometimes for around 2 marks, they might test the theories as well. We are good? Right. Then the formula is what you said, value of the estate prior to the gift or prior to the transfer minus value of the estate after the gift or after the transfer. Good. What is meant by chargeable property? What do we call as a chargeable property? What is considered as a chargeable property? A property given to trust. Okay, all right. The others, what are your thoughts? Elankesh, Ijaz, Ahid, how about you guys? What is meant by a chargeable property for inheritance tax purpose? Okay. Property subject to IHT. So how do you define which property is subject to IHT? Transfer to trust. Right. Okay, guys. Again, basics. What is meant by a chargeable property in theory is any property that is beneficiary entitled by the donor. But for your exam purpose, any property is considered as a chargeable property. Are we clear? We are good? So don't forget the basic concepts, guys. This is where we go wrong. We just focus on the calculations, on the numbers. But sometimes that is not what expected in the exam. Certain questions are not revolving around the numbers. So don't only focus around the numbers. I told this from the beginning. Don't focus only on the numbers, focus on the concepts. Numbers will automatically come. If you know the concept, automatically the numbers will come. So try to grab the concept. Right. Who's a chargeable person then? The third concept. Who can we consider as a chargeable person? Donor and donee to whom IST is imposed. That depends. Okay. All right. Again, guys, these can be theoretical questions in your exam. So don't forget these theoretical aspects. Theoretically, any person domiciled in UK is liable for IHT, so we call them as chargeable persons. For your exam purpose, any person is considered as a chargeable person. Are we clear? Right. So guys, again, again, I'm requesting, please do not forget the concepts because these basics can be tested at any point. And if they are tested, you will be in a deep trouble if you don't know the concepts, right? So this part already we discussed what is a chargeable property and who is a chargeable person. Then we are coming to chargeable occasion. So what are the chargeable occasions for IHT? How many occasions are there? How many chargeable occasions are there? Okay, I got one answer as two. The others? Okay, three. CLT and PET. Okay. Elankesh, what are the three occasions that you are referring to? Okay, right. So there are two main occasions, that is during the lifetime and upon death. During the lifetime, we have two categories of transfers, that is CLT and PET. So CLTs are taxable and PETs are not taxable during the lifetime. Upon death, on all lifetime transfers during the last 7 years, and on the death estate, IHT is liable. So altogether, there are three. CLTs during the lifetime, all lifetime transfers upon death, and the death estate upon death. Are we clear? They are good with the three main occasions where IHT might charge. Guys, are we clear? Awesome. Then, what are the lifetime gifts that might have? So we have three kinds of lifetime gifts. We have potentially exempted transfers, in short form we call as PET. We have exempted transfers, and we have chargeable lifetime transfers, which we call as CLT. What is meant by a PET? Guys, what is meant by PET? Transfer to family. Potentially, okay, I agree, potentially exempted transfer. What is meant by that? What kind of transfers get classified under potential exempted transfer? Correct. PETs, we are talking about transfers from one individual to another. It's not only family members, guys. It could be any individual. So if I transfer anything to an individual, that is going to get classified as a PET. So it's all about one individual to another. Then what is a CLT? Transfer to trust. Is it only trust? Individual to trust. Okay, did we learn anything like that? Individual to trust? Did we learn anything like that? What do we mean by a CLT is any transfer except for a PET or exemption. So it can be a transfer from an individual to a company. It shouldn't, I mean, there is no requirement that it should always needs to be an individual or a trust. The common example is one individual to a trust, but it can be from individual to a company as well. Individual to a partnership. Are we clear? Right. So PET means transfers between individuals. CLTs means transfers except for PETs and exempted ones. So PETs, what is our tax requirement when it comes to PETs? Lifetime transfers are during while the donor is alive. During the lifetime, there is no inheritance tax with regard to the PETs. Until the donor is alive, no IHT is payable on the PETs. Correct. We calculate the chargeable value, but we do not charge any tax. Good. If the donor lives for 7 years after the gift, there is no IHT on the death as well. But unfortunately, by any chance, if the donor passes away before 7 years from the gift, then IHT will be charged upon death. Are we clear on the treatment for PETs? Simply, PET means a transfer between two individuals. While the donor is alive, there is no IHT payable. If the donor lives for more than 7 years after the gift or after the transfer, no IHT will be charged. But by any chance, unfortunately, if the donor passes away before 7 years, then IHT is liable even on PETs upon death. Are we clear on the PET part? Any questions around PETs? Alankesh, Ijaz, Rashid, are we good on the PET part? Right. Then coming to CLTs. CLT means anything except for exemptions and PETs. And during the life, IHT will be calculated based on the lifetime tax rates. So even while the donor is alive, an IHT will be calculated on the CLTs. And if the donor dies before 7 years after the gift, an extra IHT will also be charged on the death tax rates. We are clear on the CLTs as well? Any questions around that? Elankesh, Rashid, are we good? Right. Elankesh, I hope no means no questions. Am I correct? Right. Then exemptions and reliefs. When it comes to exemptions and reliefs, again, there are two kinds. One, exemptions and reliefs only applicable for lifetime gifts. That means PETs and CLTs. Second kind of exemption is which is applicable for lifetime gifts as well as for the death estate. That means PETs, CLTs, and the death estate. Can someone recall what are the exemptions and reliefs that are available for lifetime gifts? Only for lifetime gifts? Anyone who can recall? Guys? Okay, small gift is there. Small gift, annual exemption, marriage exemption. Okay, what else? All right, so we have small gift exemption. No, nil rate band is not an exemption. Yes, it's a relief though. Yeah, correct. Marriage exemption, normal expenditure out of income exemption, annual exemption. So these are the four exemptions applicable for only lifetime gifts. So what is meant by a small gift exemption? What is meant by small gifts? Great. So if the gifts given to per person per annum, the cumulate value, if it is less than 250 pounds, those we consider as small gift exemption. So keep in mind per person per annum 250, the cumulate amount, not per gift value. It's per person per annum, not per gift, the cumulate. Are we good? Rashid, are we okay? Great. So how does the marriage exemption works? So that should be during a marriage. The results, the reason for the gift should be marriage. If parents give, how much is exemption? 5,000. It's not for son. It could be for son or daughter. It's 5,000. Up to 5,000 pounds. Then, uh, yes, 2,500 for ancestors. So it should be grandparents or someone. And a party to the marriage, 2,500, 1,000 by anyone else. Okay, good. Now I have a question for you. Let's say a couple is getting married. What is the maximum amount they can claim as marriage exemption through their parents? Let's say groom has only father and the bride has only mother. Yes, great. 10,000 from both. So each party will have 10,000 because 5,000 per parent. So each party will have 10,000. Are we clear? This was again a question in the exam paper. It was tested once in the exam. We are good with that, Alankesh? Yes, correct. So each parent 5,000 and each party 10,000. So groom will have 10,000, bride will have 10,000. You can go up to 20,000. Are we good, Alankesh? Right. You never know. They might test it again, Rashid. You never know. So let's be prepared. Right. So what do we mean by normal expenditure out of income? This is where if the gift does not create any impact on the donor's lifestyle, and if it is out of the normal income of the donor, then we call it as normal expenditure out of income. Example, Elon Musk donating 100 pounds to someone doesn't have any impact on his lifestyle, right? So that will be a normal expenditure out of income. Annual exemption. How much is annual exemption? Great. It's 3,000 per year. Let's say this year's annual exemption I did not use. What can I do for that? If I didn't use my annual exemption, great. If I did not use my annual exemption, I can carry it forward for 1 year. Keep in mind though, only 1 year. For 1 year, I can carry it forward. Good. Then lifetime transfer, lifetime gifts and death estate. So these are applicable for both inter-spouse exemption mainly. Then we have this nil rate ban, residence nil rate ban, all this stuff. I'm not going to discuss all those theories. Shall we move on to a few questions then? Are we good to try a question? Great. Okay. First, let's move on to June 2021. Question number 2. No, this not this one. December 2020. Right. We have the question here. First one contains 3 marks. So 3 marks means we can use wait, let me check the time. 1.8 to 5.4 minutes. So can you try this question within 5 minutes? Guys, would you mind giving it a try? Within 5 minutes? Okay, I'll give you around 7 minutes. So you need to go through the question as well. Can you give a try? 7 minutes max. Actually, can you guys log into the portal if you guys have your laptop with you guys? Do you all have your laptops with you all or desktops or whatever? Elankesh, do you have the access to your laptop or something? Okay. Rashid, how about you? Right. Okay. So for today, just use the screen and try to do the question. But from next day onwards, guys, since we are planning to move on to the portal and try the past papers as well, if possible, have a computer by nearby you. So when we are attempting, you can attempt on the portal itself. So Rashid, since you have the laptop with you, just log into the portal and try to do the answer in the portal itself. So we are familiarized with the portal stuff. For Elankesh, we'll just use the what do you call manual method. Okay, guys. Unfortunately, I can't reduce the screen size more than this. Can you guys give a try within 7 minutes? Elankesh, Rashid, would you guys mind giving it a try? Wait, max 7 minutes, guys. Give it a try. Rashid, are you sure on that? Because I'm in the portal actually. What is the error message that you are receiving? We couldn't load your qualification information right now. Okay, give me a second. Try whether it is possible using this link. So that's, I think you guys are trying through my ACC, right? This is the longer path that I use. Can we try that path as well and see? Can you try to use the bounding? It's a longer path, the common path. Okay, let me share the link in the WhatsApp group as well. Can you try to log in now? No, we have around 3 requirements in this one. The entire thing is not relevant for this question number A. Rashid, did that link work? Rashid, did it work? Okay, guys, let's do this one together. Yeah. Okay. Rashid, meantime, you assign it, and only this part we will discuss. Then I'll give you time for the next part again. Okay, great. Then you should have the answer, no? You should know the exact answer then. Okay, let's go through the question. You should assume today is 6th April 2019. You are a trainee chartered certified accountant dealing with the tax affairs of Aurora. Let properties. Aurora's own 3 freehold residential properties, which are let property 1 and 3 qualify for private residence relief, so PRR, because at separate times they were previously occupied by Aurora immediately after purchasing each one. These two properties also have outstanding interest-only mortgage. Details are given. So we have three properties. We know the current value, outstanding interest-only mortgage, chargeable gain if sold before any reliefs, period of ownership, period lived in as PRR throughout ownership period. All three properties have been let out during any period when not occupied by Aurora as a principal private residence. None of the properties were let as furnished holiday accommodations. Then inheritance tax. Aurora's only other asset in her current main residence valued at 500,000. This property does not have a mortgage. Under the terms of her will, Aurora's entire estate is left for her children. Aurora's husband Andrew died on 15th August 2017 with all of his estate left to Aurora. During February 2017, Aurora and Andrew both made lifetime gifts of assets to their children, which fully utilized their respective inheritance tax nil rate bands of £325,000. Sale of one of the three let properties. Aurora is planning to sell one of her three let properties during May 2019 and wants to sell one which results in the lower chargeable gain after taking into account any available reliefs. Her rough calculations indicate that it will be property 3. Personal pension contribution. After selling one of the three properties and paying off the outstanding mortgages, Aurora will have £120,000 available. She wants to use this money to make net personal pension contribution of £40,000 in each of the tax years 2019-20, 2020-21, and 2021-2022, and would like to know the total amount of income tax relief from which she will benefit as a result of making the contribution for the tax year 2019-20. Aurora has sufficient unused brought forward annual allowances to cover the three annual net pension contributions of £40,000. For each of the tax years 2019-20, 2020, 2021, and 2021-2022, Aurora will have taxable income of 87,500 after deducting personal allowance. So in our case, it should be 12,570 from her total income of 100,000, consisting of self-employed profit of 80,000 and property income of 20,000. Okay, fine. Requirement number 1, calculate the IHT payable in respect of Aurora's estate if she were to die on 6th April 2019. So it's a very basic question, right? We know the values of the properties. So we just need to calculate the total value, give whatever the relevant reliefs that she has, and then apply the rate. Okay. What are the reliefs available for Aurora in this case for IHT? Is she entitled for any relief for IHT here? Any kind of relief that you figured out that is applicable for Aurora? Annual exemption. No. We are talking about the death estate, right? So did we allow annual exemption for death estate? If you go back to the slide that we just discussed, annual exemption was only for lifetime transfers, not on the death estate. So what are the reliefs and exemptions that Aurora can use? Yes, Elankesh, Rashid, what are the exemptions that she can use? Residence nil rate ban. Okay, all right. Residence nil rate ban she can try. Okay. What else? Elankesh, you mean residence nil rate ban is fully utilized, is it? The nil rate ban is fully utilized. That's what you're trying to say. Am I correct? Okay. What about Andrew's nil rate ban and Andrew's residence nil rate ban? Her husband. Anything that we can use from those? Both. Andrew also would have residence nil rate ban as well as nil rate ban, right? Who has died. So can we do anything about it? Andrew's residence nil rate ban and the nil rate ban. Yes. Can he transfer anything to Aurora and give some benefit? Utilized group has made lifetime gifts. So only available both residence nil rate ban. Okay. All right. Let's see. So as usual, guys, I am mentioning for whom I'm calculating and what am I calculating. Market value of the rented properties. So she had two different properties, rented ones and the main residence. So rented ones, each valued at 350. So 350 into 3, which is 1,050,000. Then she has the main residence, which is valued at 500,000 pounds. Again, we are talking about the death estate tax. Therefore, the mortgage value also can be deducted, which is 115,000 for property 1, 115,000 for property 3, 230,000. So the value of the death estate is 1,320,000. So like you guys said, the two residence nil rate bands we can use and the nil rate bands are fully utilized. So no nil rate bands are coming into the picture, but both residence nil rate bands can be utilized. As a result, once I deduct that, the taxable estate will be only at 970,000 pounds. Sorry. The inheritance tax rate is 40%. So I applied 40% on 970,000. I'm ending up with the inheritance tax of 388,000 pounds. Uh, why do you think it is already used, Elankesh? Okay, let's go back to the question. Andrew's part. So all Andrew's estate was transferred to Aurora, right? Is Aurora a direct descendant for Andrew? Is Andrew a direct descendant to Aurora? Sorry. Is Aurora a direct descendant to Andrew? No, right? We only consider children and grandchildren as direct descendants. So for Andrew, Aurora is not a direct descendant. So that means at the time of Andrew's death, nil rate band, so residence nil rate band wouldn't have used at all, isn't it? Because residence nil rate band can be deducted only if the residence is transferred to a direct descendant, which Andrew hasn't done. So Andrew's full residence nil rate band is available. So that is why I claim Andrew's one. When it comes to Aurora, Aurora is transferring the house to his for her children. So that means she is transferring for the direct descendants. Therefore, Aurora's residence nil rate band is also applicable. That's why I took both residence nil rate bands. Elankesh, are we clear? Yes, there are a few instances that we discussed where you can transfer the residence nil rate band, isn't it? One, there was no residence at all to transfer. Two, the residence was not transferred to direct descendants. Three, the value of the residence was less than 175,000. So these are the three situations where you can transfer the residence nil rate band. Am I correct? Right. So any further questions on this part of the question, guys? Uh, Elankesh, Rashid. Okay, Rashid is okay. Elankesh, how about you? Any further questions on this part of the question? Right. Then let's move on to the next part. Assuming Aurora does not die on 6th April 2019, for each one of her three let properties, calculate the chargeable gain after taking account of any available reliefs, but before deducting the annual exempt amount. If she sells the property during May 2019, 3 marks. Can you try this one? If I give 5 minutes, can you guys try this one? It's a very quick, easy one. Telankesh, Rashid, would you guys be able to give a try? Great. So I'll give you maximum 5 minutes, guys. Give it a try. Okay, guys, how's the C2? Elankesh, Rashid, were you guys able to give it a try? Great. So what was the answer you got, Rashid? Come on, there is no harm if your answer is wrong. No problem. What's the answer you got? Elankesh, Rashid, both? Okay, we'll start discussing. And by the way, guys, I'm okay. I got the answer from. Okay, great. So I got Rashid's answer. Elankesh, how about you? Okay. By the way, guys, I'm having a heavy thundering situation here. So we'll continue as long as possible. Okay. Coming back to the question. So we are talking about. I did this question twice before. So okay, okay, all right. We'll see. But first part you couldn't answer, right, Rashid? Right. So that is after being familiar. No worries, no worries. So don't worry, guys. We are doing questions as much as possible so that we can, overcome these obstacles and make sure we score the full marks in the exam. Right. Coming back. What are the reliefs available here? First of all, any relief that comes into your mind? What are the reliefs applicable? Okay, good. PRR is there. Any other relief that you can think about? Okay, let's see how it goes. Again, as usual, I'm mentioning for whom and what. I'm calculating for Aurora chargeable gains after reliefs. So I had all three properties in this way. And the chargeable gain before the reliefs, we already know it has been given. This one 100,000, 150,000, and 150,000. Then, like you guys said, PRR is the only relief that is applicable here. So I'm calculating the PRR. For property number one, the total ownership period is 15 months. Sorry, 15 years. Out of that, 2 years she has stayed there. Property two, nothing at all. Property three, 20 years. Out of that, 12 years she has occupied. So first one, the gain 100,000 divided by 15 into 2. The PRR would be 13,333. Property 2, no PRR, so the full 150,000 will be taxable. Property 3, 150 divided by 20 into 12 would be the PRR, which is 90,000. So the chargeable gain after reliefs would be 60,000. Rashid, where did we go wrong? Okay, great. Rashid, where did we go wrong in your answer? 9 months. No, the letting relief will not come into the picture because what do you call the we don't have any information about renting out while occupying, right? The question says it is rented out when she is not occupied. Therefore, what do you call letting relief doesn't come into the picture. For letting relief to be applicable, the house should have been rented out while occupied. This question says whenever she was not occupying, it was rented out. So that means letting relief is not applicable. Are we good, Elankesh? Right. So coming back to Rashid's question, for last 9 months, we cannot take here because if it's fully let out, yes, if it is fully let out, letting relief is not applicable. Letting relief comes into the picture only if while occupying you use that. Okay, the last 9 months one we cannot apply here because this has been rented out, number one. Worry about 9 months since already PRR information is given, right? So last 9 months we cannot consider here, Rashid, because what you called like Elankesh said, the numbers are given here. So we have to assume that is including that. It's we did not calculate the number of months or years. It was given for them. They are clearly saying the PRR, the period lived as PRR throughout the ownership period. So it's the PRR period that we have considered. So straight away they have given that. Therefore, we cannot take the last 9 months. Are we okay, Rashid? Right. So any further questions on part B, guys? Anything that you guys are not clear? Can I move on to the next part? All right, great. I'm moving on to the next one then. Next one has two parts. Calculate the total amount of income tax relief which Aurora will benefit from as a result of making a net pension contribution of 40,000 during the tax year. You are not expected to prepare the full tax computation. Can you do part one of part C within 5 minutes? Can you give it a try? Elankesh, Rashid, Ijaz, can you guys give a try? Great. So guys, 5 minutes, give it a try. All right, guys. How's the situation? Were you guys able to complete it? Guys, Elankesh, Rashid, Ijaz, how's the situ? Were you able to attempt it? Guys, are you all there? Elankesh, Rashid, Ijaz, are you guys there? Okay, all right. Rashid, how about you? Same here, Ijaz. I am also having the same issue. It's heavily thundering here. Rashid, how about you? Okay, let's discuss it together then. Okay, so we are talking about a net contribution of 40,000, right? That is what they are talking about. Yes, they are specifically mentioning it's a net contribution of 40,000 pounds. So if you are making a net contribution of 40,000 pounds means the gross would be 50,000. 40,000 divided by 80 into 100. That would be the gross, which is 50,000. Your usual basic rate band is exactly. So this will result in an extension in your basic rate band. So your usual basic rate band is 37,700, but now that is extended up to 87,700. And your taxable income, I will use the taxable income they have given. So they are saying the taxable income of 87,500. So I took the taxable income as 87,500. So out of this 87,500, now additionally, 49,800 is getting exposed to the basic rate band, isn't it? Earlier, out of this 87,500, only 37,700 was supposed to be exposed to the basic rate band. But now, additionally, 49,800 is also getting exposed to the basic rate band. Are we clear? Right. Okay, Elankesh, what's the question? Sorry. So simply, this is your taxable income. Out of this, initially only 37,700 was supposed to be exposed to the basic rate band, right? But now, instead of this whole amount, 37,700 minus 87,500, because your new basic rate band is going up to 87,700, which is above your taxable income. That means the full amount is now getting exposed to the basic rate band. So this 49,800, which was supposed to be exposed to the higher rate, now getting exposed only to the basic rate band. Elankesh, are we clear? Elankesh, are you there? Are we good? Nine 9,960. Okay, we'll come to that one. We are still at one point, that is here. We are still at here. I'm explaining at this point yet. So we'll go step by step. Are we good, Elankesh? Up to 49,800, are we okay? Right. So this 49,800 was initially supposed to be exposed to a rate of 40%. But now that is going to get exposed only to a rate of 20%. Are we agreeing on that, everyone? Elankesh, Ijaz, do you guys agree on that comment? So taxable income is not going to change, guys. Either situation, taxable income is the same because we are not deducting or any impact will not be there from pension contributions on the taxable income. So your taxable income is not going to change. The only thing that is going to change is your income tax calculation. For taxable in, okay, I couldn't see the full screen. Okay. So the taxable income is 87,500. Are we okay, Lankesh? Right. So what I'm trying to say is your taxable income is not going to change, no, which was 87,500. Earlier, 37,700 of that was supposed to be exposed to 20%, and 49,800 was supposed to be exposed to the 40% rate. Are we agree on that? Everyone, are we agreeing on that? Rashid, Ijaz, are you guys agree? Great. So that means now because of this pension contribution, 20% you are paying lower taxes in it. On this 49,800, instead of paying 40%, now you are paying only 20%. So you do have a 20% saving upon this 49,800. Do you agree on that as well, everyone? Ijaz, how about you? Right. So 49,800 into 20% would be 9,960. That is the initial tax savings that we have. Do you agree on that as well? Rashid, Elankesh, how about you guys? Great. So that is the tax savings as a result of the tax rate band extension. But apart from that, your actual donation was only 40,000. But we gave you a 50,000 benefit, 10,000 extra, an upfront benefit. Isn't that also a benefit for you? Rashid, Elankesh, Ijaz, do you agree on that? Right. That means the overall benefit would be 9,980 plus this 10,000, which is 19,960, isn't it? Great. The others, Elankesh, Rashid, are we okay up on this answer? Okay. So the upfront benefit means actually the amount that you paid to the pension scheme was 40,000. Do you agree with that, Elankesh? Right. But we did give you a benefit of 50,000, not 40,000. Do you agree on that as well? Right. So that means extra 10,000 benefit we have given to you apart from the tax savings from the band extension, isn't it? So if this 10,000 was not there, your tax savings, this 9,960 is going to further reduce, isn't it? Because then we are not extending by 50,000, we will be extending only by 40,000 then. Don't you think? So then the 10,000 is also impacting you, isn't it? Right. So the overall tax benefit that you are having would be therefore 19,960. Are we okay? Right. All right. So I told you this question is an interesting one, right? How was the question overall? What is your feeling about the question so far? Elankesh, Rashid, Ijaz? Yes, it's a 10-mark question. Yes, we will be doing more recap questions, Rashid. So technically, I want to do a revision on a small revision on VAT and corporation tax. After that, the balance period, we will be focusing only on questions. Are we okay? Rashid, would that be fine? Great. Okay. Uh, Next theory class, I'll get back to you, Elakesh, on that. We will keep that out of the revision program. The next revision one, as usually, would be on Tuesday, next Tuesday, the usual time, starting from 7 o'clock. We are good? Great. Okay, for today, let's stop at this point, guys, because it's no, that is for the theory classes, no, Lankesh, we'll discuss that separately. Let's keep it out of TRG. So we'll stop at this point today, guys. It's a very heavy thundering situation around here. I didn't want to stop the question in the middle, so I continued it. Now the situation is really bad. Shall we stop at this point and continue from the next class? Great. Then thanks for the participation, guys. Like I said, if there are any queries or anything that you guys are not clear, just revert to me. I will definitely revert to all your queries. So the theory fellows knows that I always revert to their questions. So just drop me a message if you have any kind of a question. Right. So then let's wind up for the day. Thank you very much for your participation. Let's catch up on the next class, guys. You're most welcome, guys.